Yes. Before we begin, I do want to remind everyone that the discussion that we'll have today may include forward statements that could cause actual results to differ from expectations. We encourage you to read the published quarterly results alongside the audited financial statements for the year ended August 31st, 2025, and the management discussion and analysis. So these documents can be located on the Jamaica Stock Exchange website and also on the SYGNUS Group website in the Investor Relations section at www.sygnusgroup.com. So I will now go ahead and introduce our presenters for this session. Today we have the Chief Investment Officer and Executive Vice President of SYGNUS Capital, Mr. Jason Morris, Vice President in the Investment Management Unit at SYGNUS Capital, Ms. Justine Powell, and Vice President and Head of Real Estate and Project Finance at SYGNUS Capital, Mr. David Cummings. So following the remarks from today's presenters, we'll be taking questions. So encouraging our participants to, feel free to partake in the discussion by using the Q&A feature in the Teams platform or submitting on the YouTube Live platform or via email at srf@sygnusgroup.com. So I'll now go ahead and hand over to our presenters.
All right, good morning. Thank you, Kyle. Good morning, everyone. I'm Justine and I'll be taking us through a part of the presentation today. And as usual, my colleague David will also help with presenting what we have today for you. Hope everyone is doing well. So we do want to start off, as usual, providing an update on some of the achievements that we had during the period. Next slide, please. Right, so I want to start the discussion off by looking at Lake Spen Industrial Park. And I will spend a little bit of time on Lake Spen. The defining milestone that we had this quarter is the commencement of construction at Lake Spen Industrial. And Lake Spen represents a $4 billion logistics and commercial hub that we're developing in St. Catherine. And it represents SRF's largest development project to date. Now, this is actually our third development, and it follows Spanish Penwood and One Belmont that we would have developed prior in the first investment cycle. And I believe each one has been more complex and more ambitious than the last. So we started off with the build-to-suit industrial, we moved to the 9-story commercial tower, and we're now executing at scale in the logistics and the industrial space. So we're very excited about that. For the first investment cycle, we would have dedicated it to building our development capacity and accumulating what we refer to as execution evidence. And this would have included originating the right assets, assembling the right teams, and just delivering on our commitments. So Lake Spen sits in our second investment cycle, and it will be a direct beneficiary of everything that we built in the first investment cycle. That foundation, it's important, and our shareholders will see it in how we execute this project that we're now doing. Now, the strategic rationale that we have for Lake Spen is also very straightforward, but very compelling. And I want to spend some time discussing that as well. So the industrial and the logistics space in Jamaica is significantly undersupplied right now. And we're starting to see some tailwinds converging. We're seeing e-commerce growth. We're seeing nearshoring trends across the region. And we're seeing where there's continued investment in Jamaica's infrastructure. Now, with all of this taking place, we also have some global dynamics that are happening. We see geopolitical risk. We're seeing supply chains being disrupted. And what this means is that businesses are now under real pressure to localize and diversify their logistics footprint. And Lake Spen, of course, is perfectly positioned to be a part of that solution. So we have the right asset, it's in the right location, and we believe it's the right time. So we're not chasing the sector, we've placed ourselves in the sector, deliberately. And this was from 2020. So there's another aspect that I would want to discuss here, and still in relation to Lake Spen, the ESG dimension. It matters, and it matters more these days. We're seeing a lot of climate shocks, they're more frequent, they're more costly, and the market is demanding that the infrastructure that is being built is built in a way so that they can withstand these climate shocks that are taking place. And we did not forget about that when we were designing Lakespen. So Lakespen is designed with this resilience at its core. And so not only is it good development practice, but this is what sophisticated owners, investors, occupiers are looking for. And again, SRF is ahead of the curve because we've ensured that Lakespen will deliver on that as well. And lastly, with respect to Lakespen, what makes it strategically significant for SRF is what it represents on the liquidity side. Now, this will be one of the most meaningful capital recycling events for us in SRF's history, if I'm being honest. And we're going to be generating sale proceeds that will not only be redeployed in the next generation of assets that we're looking at, but also be available for our shareholders to participate in. So we're looking forward to that. And I now want to segue, of course, into the other achievements that we had during the period. So beyond Lakespen, we continue to deliver on several other fronts. We're seeing where One Belmont is 100% complete. Our third tenant build-out is advancing, and we're expecting occupancy to take place in 2026. Now, we're also actively structuring our partial exit, and we will, of course, continue to provide our shareholders with updates on that as we advance them. And when it comes to deployment and exits during the period, we would have seen some active portfolio management taking place there in the form of 355 million in new investments, or 355.89 million in new investments, and 264.84 million in exits during the first half of 2026 financial year. And lastly, on this slide, I have to touch on the returns that we have been delivering to our shareholders. And this is a since inception metric. We've generated about 1.74 times the paid in capital that shareholders would have provided. And we tend to show our metrics not just at the financial year, or not just on a financial year basis, but at the investment cycle level as well. Why? The nature of SRF calls for us to show how the fund or the portfolio is performing over the investment cycle and not just the financial year. All right, thank you. All right, so moving to this slide now, and we're going to touch on the performance for Q2 2026. And the first one is the net profit. So if you look at the Q2 2026 versus Q2 2025, we're seeing where the numbers look very different. So I want to spend some time first just reminding our viewers, listeners, what would have taken place last year to cause results to look materially different. Now, during the second quarter in 2025, we would have acquired an additional stake, 16% stake in One Belmont. And of course, this was done by acquiring shares in Audio Holdings, which is the joint venture entity that holds the One Belmont asset. And so because of that one-off transaction that we had in the 2025 financial year, we were able to essentially have an anomaly, because we're used to having lumpy interim period results. We were able to report positive numbers in 2025 financial year. So what we're seeing now is more in line with what we typically see for a portfolio like SRF during interim periods, where we would have had net loss of 215.9 million, total investment income of negative 112.22 million, and net investment income on negative 277.47 million. Again, once we get to the end of the year, of course, we're going to be able to see and capture SRF's full earning potential. But as usual, during the interim periods, we typically see the results looking this way. Continuing here, we saw earnings per share of negative 0.62 relative to 0.12 last year, similar period. And we did have our book value per share of $25.39. So this is Jamaican dollars, which is up 5.6% year over year. I would have already touched on the total value to paid in capital, so I won't repeat it. But when it comes to our average return on average equity, we are recording about 17.47%. Next slide, please. All right, so on this slide, we actually have the performance highlights for the entire 6 months ended February 2026. So the prior slide would have been the quarter only. And we are seeing for the 6 months a net loss of 398.21 million versus a net loss of 197.45 million last year. A total investment income was seeing negative 135.41 million versus investment income of 26.59 million last year. And for net investment income, we're seeing negative 427.66 million relative to negative 160.21 million in the previous year. Again, the rationale would have been the same as on the prior slide, which is that the acquisition that we did in the prior year, where we took on an additional 16% stake in Audier Holdings, which took our ownership from 70% to 86%, is what would have caused the significant differences year over year. We can move to the next slide, Andre. All right, so on screen now we have our performance highlights for the 6 months ended February 2026. And there are just a few lines that we want to, emphasize, spend a little bit more time on and discuss with you. And the first one is the net interest income. So if we look at the 6 month 2026 column, and compare it to the 6 month 2025 column, we see that net interest income would have actually improved, though still negative, to a negative 173.31 million compared to negative 215.85 million. And I want to spend some time here because this is consistent with some of the strategic initiatives that we are currently working on for SRF, where we are more deliberate in growing our debt portfolio, or what we refer to a lot as our REIN portfolio. Now, just for some context, the interest income that SRF generates, it comes from the investments that are done in real estate investment notes, and these are typically third-party projects. So these are not SRF's own projects like a Lakespen or even Belmont or Spanish Penwood. These are projects belonging to third parties where we are investing debt capital. And so in investing debt capital, we have a note that we invest in, which typically has contractual flows, whether it's a coupon or some interest payment. And of course, it would have some sort of principal payment, whether it's amortizing or bullet. And so again, what we're seeing here is that we've been working deliberately to reduce this negative margin that we have here. The aim, of course, is to eventually get it into the positive territories. Of course, it's going to take time because we're deploying into real assets and real projects. Now, for the next item that I would want to spend some time on, it's our total operating expenses. And year over year, we can see where the total operating expenses actually increased from 186.81 million in 2025 to 292.25 million. Now, if you recall, during 2024 and the 2025 financial year, SRF would have actually benefited from a temporarily reduced management fee. And the rationale for the temporarily reduced management fee would have been due to the fact that SRF was actually transitioning from its first investment cycle into its second investment cycle. And so with that reduced investment activity, the manager agreed to a lower management fee. Now, effective September 1, 2025, which is the start of the 2026 financial year, the fee would have returned to its normal rate of 2%. And so a lot of the increase that is being shown in that line year over year is attributable to that fee adjustment or normalization that would have taken place. Now, the last line item that I would want to spend some time on this sheet is the one in relation to our fair value gains or losses on financial instruments. So SRF invests in third-party projects, and in some instances, these third-party investment notes that are used, they may require us to do a fair valuation. And so over each interim period, we have to continuously measure and assess whether there is a gain or loss coming from this financial instrument. Now we have three investments that are in relation to two projects that we have appointed a receiver for, and we refer to those as our workout assets in most of our communication. Now, the losses that we're seeing here are attributable to those assets that we have in workout. And we would have, over time, I believe, reported receivership costs in interim periods. And of course, as the receivership continues, receivership costs will continue to increase. And so we have to capture them here in the form of losses. Now, just to touch on the workout assets, and I think it'll come up again a little bit later, no investment platform that's operating at scale will go through that without encountering certain assets that require active management and recovery. And so it's essentially a part of the investment cycle and what we signed up for. So at this time, we're just navigating our way out of those workout assets. So a little bit later in the presentation, I think we will revisit that. You can go to the next slide, Andre. All right, so we have a balance sheet summary on screen here. And this is as at February 2026, of course. And I'll spend a little bit of time on this slide just to ensure that we can appreciate what we're showing here. So shareholders would have paid in capital amounting to 5.1 billion Jamaican dollars for SRF. So that's what we're seeing on the left. And since receiving that paid in capital, we have transformed the shareholders' value to $8.88 billion. And to go a little bit further, SRF has about 17.3 billion in total assets. So when we look at those assets on the balance sheet and account for all the liabilities of SRF, what is left, of course, is for our shareholders, and it's 8.88 billion. Now, as I said earlier, shareholders would have paid in 5.1 billion. And so what this means is that we have essentially returned for shareholders a multiple of 1.74. And this is something that we'll continue to track and monitor. At the end of the day, this is why we're here, to ensure that we're delivering value to our shareholders. Next slide, please. All right, so efficiency and management expense ratios. So we have two ratios that we always track and share with our shareholders, one being the management expense ratio, which we actually show quarterly, and the other one being the efficiency ratio, which we typically measure yearly. Now, these ratios, in addition to ensuring that we hold us as managers accountable, they also ensure that we're preserving the value for the shareholders. And so at the end of Q2 2026, we're seeing where the management expense ratio, it remained within the threshold of 3.5% that we have. Now, there were some one-off expenses during the first half of the year, so we are expecting this to, once we get to the end of the year, to even come in a little bit lower. But yes, so we reported 3.4%, still within our threshold of 3.5%, which is good. Now, there may be a question, so I will, just answer before it comes in. Why is it so much higher than the prior year, where we reported a management expense ratio of 2.5%? And it's very simple. The management fees that SRF pays are rolled up into this metric as well. And so with the temporary adjustment in fees ending in August 2025 and us returning to a normal rate of 2%, we would have seen this translate into the management expense ratio metric as well. For the efficiency ratio, as I said, we don't measure this one every single quarter. And the main reason is that we have to capture the full income potential of SRF, which doesn't show up until we get to the year end. When we had last measured this metric, we were at 26.8%, which is very much within the threshold of 45% that we've set for the fund. You can move to the next slide. All right, so we're going to go into a summary of the investment activity during the period and just give a breakdown of the various assets that we have on book. And I want to start off with, of course, total real estate investment assets. I would have mentioned earlier that SRF has total assets of about 17.3 billion. Now, real estate investment assets represent, of course, the bulk of that. 16.69 billion compared to 14.82 billion last year. Now, when we look at total property investments or investment properties, we recorded 10.78 billion at the end of the quarter compared to 10 billion last year. For real estate investment notes, we reported 1.91 billion compared to 2.3 billion last year. Joint ventures reported 3.99 billion compared to 2.52 billion last year. And during the first 6 months of the 2026 financial year, we recorded 0.26 billion in exits compared to the prior year where we had much more exits of about 1.72 billion as we would have been closing out our first cycle. Now, real estate investment notes, which is at 1.91 billion. I do want to mention here that we are keen on growing this segment of the portfolio. Again, these are the real estate investment notes that I would have referred to on the prior slides. And this is going to allow SRF to, one, manage that negative net interest income that I would have shown earlier and drive the interest income line on the profit and loss statement. We can go to the next slide. Investment allocation, a good segue from the first slide and the comment I just made. On the right, we can see the same breakdown of the balance sheet where majority of the assets are investment properties, followed by joint ventures at 24%, and then real estate investment notes a little under 12%. And lastly, lease participation investments at 2.7%. So my comment remains the same. We're keen on growing the investment note segment of the portfolio. Now, in terms of capital that we've deployed entirely into the Jamaican economy. We'll say that SRF's mandate does allow them to, or does allow the fund or the portfolio to invest across the Caribbean, and that is something that we're exploring every day. And when we get to the strategic updates, I will definitely provide some more info on that. Next slide, please. All right, so at this time, I'm going to hand over to my colleague, Mr. David Cummings, and he is going to take us through the updates on the various assets. Over to you, David.
Thanks, Justine, and good morning to everyone. As you can see on screen, and I'll be going into some of these here in a bit more detail. The one in the middle that is highlighted, Lake Spend, is the one that is currently in progress in terms of the development. We can go to the next slide, please. And we start with our Lake Spend, which is our flagship industrial project. As alluded to before on previous earnings calls, this is our first major project in our second investment cycle. And there's actually a live website available for the development where interested purchasers can visit to get specific details of the project. You can see it there on screen. It is lakespendindustrialpark.com. And I certainly encourage persons to take a look at the website and explore it. It'll give you a lot of details about the project and what is available. The next slide, please. I'll just highlight some of the key features. And the reason why we're highlighting these key features is the fact that we believe that our project is differentiated from other offerings in the market. And two of those key features that I'll highlight here is the fact that we have an underground electrical distribution system. And why is that key and important? Well, it's Hurricane Melissa. I believe some of the lessons learned from Hurricane Melissa and those who were old enough from Hurricane Gilbert is the loss of productivity after a major hurricane or a major storm is always a challenge. So if you can design in resilience in the project from day one, as I believe as Justine highlighted earlier, it bodes well for business continuity. So by routing all of the electrical infrastructure for the project underground, it means that there's nothing for the hurricane, no poles to be blown down or to be destroyed. So the morning after a hurricane, you should be able to flick your switch and business as usual. And on the other key feature I'm highlighting here is with respect to security and the fact that it is a gated industrial park. So there'll be a 8-foot concrete wall with anti-climb spikes around the entire 55-acre site with armed entry gates. And therefore, the persons who purchase and develop their businesses, whether it's cold storage, whether it is light manufacturing, assembly, or distribution, whatever it is that the purchasers do, they can do so with peace of mind that they are ensconced within a secure industrial park. Next slide, please. So this gives a quick overhead snapshot of what the subdivision looks like, as well as the professional team. They clearly, I can assure you that we have an encouraging velocity of sales. So any persons who will be interested, we have a realtor catalyst who you can go to, and they will let you know which of these lots may still be available for interested purchasers. But as you can see, it is a very well designed and laid out industrial facility, and a lot of effort went into understanding the market needs and preparing us for to come to market with this particular product. Next slide, please. Just a couple of pictures here from, I believe, on the earnings call in January. We alluded to the fact that we had a groundbreaking ceremony in December. The keynote speaker was the Prime Minister. So this next couple of slides just shares a couple of snapshots from that formal groundbreaking ceremony. The good news, as you heard Justine indicate at the beginning, is that the project is already live, and we have the contractor. It's in the public domain already. China Harbour is the contractor, and if you drive past the site is live, active. Construction is underway. So we are confirmed that we're well into the construction of this project. Again, the first major one for our second investment cycle. The next slide. Again, just a couple more pictures from the actual groundbreaking on the right, and on the left, some of our own team members, as well as some of the project management team, as well as one of the principals from China Harbour. Next slide takes us to the Mame Bay project. Of course, this is our flagship hospitality project, which we're continuing to make very good progress. Actually, we just had wrapped up a very good meeting with the entire team. As you can imagine, large hospitality investments of this nature here take considerable effort and planning to make sure that we get it right. We are comforted by where we are in the process, and before long, we should be able to come back to you all to indicate exactly, or to be able to reveal to you exactly, how those plans will materialize. The fact of the matter is that, we are determined to ensure that we unlock the optimal value of this property here, which is our flagship hospitality project within the portfolio. We'll go to the next slide, which is the Delphin Holdings. Again, you can see beautiful white sand beach there. This is our second seafront property. And just as Mame Bay, I can assure investors and shareholders that we are currently in the feasibility and assessment phase. We have several options that we have been clearly that we have to model and understand. And again, it's how do we arrive at the optimal product for this particular location that will allow us to extract the best value. As you can see, what this has going for it, one of the best beaches, as you can see, beautiful white sand beach, crystal clear water. It is astride the North Coast Highway. As the slide depicts, we're a few minutes away from the San Jose International Airport. And of course, not in this slide here, there is a couple of major well-performing hotels. There's a Marriott, there is a Rio and other hotels, so the Ocean Coral Spray within the vicinity. So we know it's a good location, and we are looking forward to revealing at the appropriate time what our plans are for this particular property. The next slide takes us to Belmont. Again, as Justine said, we are at 100% completion of the project. And just to make it absolutely clear, what we produce here is what's known as a cold shell. And each client does their own interior design and their own build out before they move into the space. There's 4 persons in the building, or 4 tenants in the building. In total, 2 are in already. The third one is about to move in. So as you can see, we are very comfortable with where things are with one building at the moment. And that takes us to the end of the presentation with respect to specific projects. I'll hand back to Justine now, who will wrap up, and then I'll be here still to take any questions which you may have.
Thanks, David. All right, so just to provide an update on the strategy that we would have presented to our shareholders. Next slide, please. All right, so starting off with some of the key strategic initiatives that we're working on. Of course, Lake Spen is at the front because it is the asset that we're currently developing, and it's at the front of the second investment cycle that we would have started not too long ago. As we would have said earlier, construction started in Q2, which is when we targeted it. And so we'll continue to provide updates as we advance that development. For 1 Belmont, this one is already completed. We're working on our occupancies, and we have the 3rd tenant occupancy that's expected in 2026. And we are also working on structuring our partial exit from this asset. And when we say occupancy, we mean, tenants actually moving into the space. Given that we, of course, develop a cold shell, you have to provide tenants with a period so that they can go ahead and do their own build out. And so the lease agreement date will not always coincide with occupancy date. So just wanted to clarify that for our audience. And the next asset, that's a key strategic asset for us, is of course Miami Bay, and David would have provided an update on that again to say that we're still working through what exactly the value creation is that we're going to be doing in relation to this asset. This is 14 acres of beachfront property, really lovely area, very central, and so we're very excited about it. And as soon as there are more updates, of course, you will hear them right here. Now, deepening access to capital, of course, our role at SRF is to provide other developers as well with access to capital, which is done through the investments in real estate investment notes that we typically do, and those are debt investments. But in addition to that, we also provide access to this flexible capital by doing co-developments, which are typically done in the form of a joint venture, which is typically where we put in equity capital. So we will continue to do that. We would have entered some new joint ventures in the prior financial year. But for this one, the main focus, of course, is, as we said earlier, Lake Spen. Now for portfolio realignment, this is something that we have to constantly look at and work on. And our aim right now is to increase the income generating assets within the portfolio. And so this could be in the form of a lease participation investment. It could also be in the form of a real estate investment note. I would have mentioned earlier that we're keen on growing that section of the portfolio. Now, for asset workout, I touched on this very early in the presentation when we were going through the results. And I would have mentioned that once you have a platform like SRF that's operating at a certain scale, you're going to encounter assets that require a little more active management and a little recovery. So it's a natural part of the investment cycle. SRF is no exception. We currently have third-party investment notes in workout, and we're focused on, 2 main things: maximizing our recovery from those assets and executing the exits as soon as it's appropriate to do so. So we continue to manage these situations with the same rigor and discipline that we apply to everything else in the portfolio, and remain confident in our ability to work through them. So that's the update that I have on the investment notes. I see a few questions submitted, so we will address those a little bit later. Now, as it relates to our footprint in the other Caribbean territories, this is something that we continue to evaluate. We have a lot of opportunities that are coming to us across the region. Various countries, I'll name a few. There's Ghana, there's Barbados, there's Trinidad, there's DOMREP. At this stage, though we're still evaluating to see, one, how do we translate our existing investment process into the other territories, right? We want to ensure that we're maintaining the same rigor and discipline that we have here. And of course, we want the ones that will allow us to unlock the most value. Now for dry powder, this is something that we speak about every single earnings call. So the first aspect of it, which is ensure that we're harvesting and redeploying. Again, we do have some assets that are closer to being exited on the debt side. So the plan there is to exit and recycle that capital. And then when you have the large assets, the plan there is, of course, to exit and pay the dividends. But still on dry powder, apart from harvesting and redeploying, which is one way that we use to access dry powder, we typically also go back to the market to access more capital. And this could be in the form of bonds, notes, credit lines. And so we do have some discussions that are ongoing with various investors, both at the fund level as well as at the individual project level. And lastly, dividends. We're keen on ensuring that the second dividend is one larger than the first dividend, but more importantly, is done at the appropriate time for SRF. So I think we can now segue into the questions. So I'll hand over to Kyle, who will moderate those.
All right, thank you for that. We have quite a few in the Q&A section, so we'll try to get through as much as possible. Starting with this one, for One Belmont, is it that one tenant is occupying 2 floors? Also, how many of the 5 rentable floors are currently occupied and should be occupied by the end of 2026?
So well spotted there. So yes, one tenant is occupying 2 floors. So that answers the first question. And the second part of the question is with respect to when the 4th tenant will move in. That's clearly still in the stages of being finalized. So I wouldn't want to release a date for that moving as yet, as that tenant is still finalizing a few things with respect to that. But we will update you once we have a date for that 4th and final tenant to actually move in.
Any other question? SRF has previously mentioned a move to monetize a One Belmont investment property via special purpose vehicles. What's the update on this project, and when does the manager expect to begin monetizing One Belmont?
Oh, I think that one is for me. Apologies. All right, so good question, actually. Sorry, I had to reread it because I was not paying attention. Sorry about that. So good question. Yes, we are working on our partial exit. I'll give an update in terms of where we are now. So based on exit that we're doing, there are some steps that will come before actually executing the exit. And they're not unique to SRF. So one, we have to ensure that we're doing our regulatory due diligence or tax due diligence, that we're liaising with the potential investors that we want to participate in this structure that we're proposing. And so we're still navigating through all those steps, and we have made some progress. We've gotten some feedback, so a lot of market read has to take place. So that is where we are in that exercise now. As to whether we will do it via a special purpose vehicle, we will save that one for another time, since we're still assessing and trying to determine how exactly we're going to complete our exit. So we don't want to speak prematurely on how it will be done.
Thank you for that. This next one will be for David. What's the plan for Mommy Bay at this point, pending Court of Appeal case? Also, NEPA rejected a beach license for Seafields. Is Seafields still exploring a hotel-like development for the property?
To answer that question, the first part of the question, I think it's advisable for us to refrain from any public statements on that. As you know, the case is sub judice, meaning it is still before the courts, so it would not be advisable for us as a public listed entity to make any utterances in public about the case whilst the case is sub judice. With respect to the second question about the rejection of the beach license, that is and unrelated, and it's in respect to a particular administrative matter that we are currently dealing with NEPA. So we're actively engaged with NEPA, and of course our coastal engineering design company who we work with to put together the application. I can assure you that we are working through that, and that rejection is not a reflection of any long-term intent. It is more a process that we need to complete with our coastal engineering team and the regulatory authorities, NEPA, for us to advance the application for that license.
Thank you. Next question. What's the update on the workout of Ocean's Edge and other stress reads?
A good question. So I would have mentioned earlier that for the assets that we have in workout, we would have appointed receivers to the companies holding those properties or projects. So the receiver is appointed, and that receiver is supporting us in recouping the capital and whatever interest we would have invested into the notes. I think you're referring to Ocean's Edge and Surreal, I'll just say what the other one is. And if you're paying attention, you'll see that it's actually listed and on the market and being sold. So that is where we are with the two workout assets. And David, I'm not sure if you'd want to add anything there.
No, I think your answer was adequate. Unless there is a follow-up question, I think we can leave it there.
Okay.
Ready, next question. What does SRF expect to do with the Montrose Road property?
Great question. We do have a plan for it, and we are clearly having looked at the feasibility of multiple options as we do for all of our properties. We believe we have landed on the optimal way to unlock the value. Of course, whilst we are tidying up the framework in the background, once that has been consummated, we will let you know what exactly the plans are. But we can assure you that we have a plan, and we are fairly confident in the direction to unlock the value. And once it's been consummated, we'll make you aware of how the value for that property is going to be unlocked.
Thanks for that, David. So the other question, SRF tapped a related party during the 6 months for approximately 800 million in financing. Is it that SRF has not finalized certain financing terms to work on some of its ongoing projects?
All right, thanks for that. Good question and good observation. So we're financing position that we have across the various projects. So no, we have finalized the financing terms. However, during our day-to-day, it's very typical that a facility, while it's finalized, it's not yet funded, and so related party transactions, which are always short-term in nature, can be used in the interim to not slow the project, but still allow us to move on while the facility or until the facilities are funded. So I would say it's a normal practice to an extent. Yeah. But no challenges really how we're going to fund Lake Spen. I figure you're asking about Lake Spen.
Right, the other question, is there a plan to deploy green capital into the Caribbean beyond the Jamaican landscape?
Good question. Yes, there is. I would have mentioned earlier that SRF's mandate allows the portfolio to deploy capital in the entire region. And so this would apply to both the equity type investments as well as the debt type investments. So yes, we can deploy the capital in investment notes across the Caribbean. We don't have any planned for the short term, meaning before the end of the financial year, but definitely something we're looking at. So when I had said earlier that we're assessing opportunities, that would have been a mix of both debt and equity opportunities. So yes, it would capture REINs.
Ready, final questions from the Q&A section. How is the expected spike in construction costs from the current energy shock slated to affect the cost for Lake Spen?
That's a great question. You'll understand that construction contracts always have within it certain provisions for how it manages fluctuations, which is the official term for any potential change in construction prices, as well as variations and other matters. And clearly, each time we do a project, we forecast as best as we can what are the market conditions. We include a reserve or a contingency for these types of occurrences, obviously material and also labor. We have to look forward at what the labor rates are and when the next cycle for the adjustment in the master builders labor rates are due to take effect. And we, as best possible, include these in our financial modeling and the development costs for each project. So, obviously, I won't go into specifics here. And we know that the spike that was triggered by the events in the Middle East, or so should I say, the ongoing events in the Middle East, will continue to have an impact. But we believe that the framework that we have in place to manage this particular project, to manage the contractor, the form of contract, and so on, gives us a fairly robust position with respect to how we manage and mitigate this particular risk.
Thanks for that, David. At this time, I'll take some external questions. What are the plans in the near term to address the portfolio allocation to get closer to the 60/40? Justine?
Sorry, I was speaking on mute. Apologies for that. So as it relates to the portfolio allocation and the plans that we have for this one to get closer to the 60/40 split, now the deliberate plans that we have around capital raising are actually designed to be deployed directly into debt investments. So we do have a pipeline of approved investments already, and we're currently pursuing some capital raising initiatives that will go directly into funding additional debt investments. So those are the near-term plans that we have to address the allocation. What I do want to say, though, is that it will take some time, and this is primarily because debt investments that we do are into projects and we're funding live construction sites. So you don't deploy the capital all at once, you do them over time. So it's something that we will see gradually increasing, but those are the plans that we have for the near term.
Thank you. Next question. When is development on Mami Bay expected to begin?
A good question, and not sure if you were on the call earlier when I spoke of the Mami Bay development, and based on what I shared earlier, we would not be given a date at this point in time until we have clear sight over the certain parameters. As you can appreciate, even when we complete our in-house assessment and finalize the plan and go through our internal governance machinery to sign off on the way we'll unlock the value, there are some external factors, obviously the regulatory authorities and so on, that will impact exactly when we will be able to start. So in short, we don't have a date at the moment. All I can say at this time is that, clearly we are working assiduously to complete the part that is within our control, and we'll work with the regulatory authorities to expedite their role in terms of the final sign-offs and so on for us to start. And once we have sight over that, then we'll be able to share with you a likely date for us to commence construction at our Mami Bay property.
This was mentioned a bit earlier, but I'll ask a more pointed questions regarding the fundraising plans for the near term, specifically this financial year.
Thanks, good question. And yes, I would have essentially touched on this in the previous question. But yeah, we are preparing to pursue some capital raising initiatives, not something that we're going to share before doing, but as usual, as soon as those are finalized, we will be reporting on it. But yes, there are plans to raise capital in the very near term.
Thank you. Final question. Liquidity position at the end of the quarter appeared quite low. Do you foresee any challenges funding the Lake Spend development?
A good question. I think this was perhaps asked earlier in a different way. No, we don't. I think I actually addressed it then before it was asked. No, we don't foresee any challenges funding the Lake Spend development. As we would have provided in the update, we already started construction. The site is, very much in progress. And we now have REB approval, which we would have mentioned, and we are selling units as well. So we don't foresee any challenges with respect to the funding of the development.
All right, at this time, I'm not seeing any more questions, so we have come to the end of our discussion. I'd like to thank everyone for taking the time to join today and wish you a good rest of the day.